Hi, this is Prios, and today I want to talk about the efficient market theory. This thesis was developed by Eugen Farmer. He is known for his work on asset pricing and portfolio theory, and he even got the Nobel Prize awarded. Let's come to the definition. The efficient market theory states that it is impossible to outperform the market because every public available information is always already reflected in the price of the underlying stock. This doesn't mean that all actors on the capital market need to be rational. If only a few people act rationally, it should be enough to get an efficient market. It also is not necessary that the available information is fully obtained from everyone. So what are the consequences? If the efficient market hypothesis is correct, it means, first, that nobody can outperform the market because of his stock picking skills, as the price is always reflecting all available information. Only insider information could enable you to beat the market, but using these is highly illegal. And second, that deep analysis of shares, for example using technical or fundamental analysis, is worthless and a waste of time. So let's review this thesis. Many academic studies come to the conclusion that the efficient market hypothesis is right, but the database is not clear, as some studies also come to the opposite result. In my opinion, the market is highly efficient, but not 200%. That means that you can outperform the market by making wise investment choices. But, and this is a really big but, most people will not be able to do so, as this requires a lot of skill and a really smart person to do so. Even most so-called specialists who work full-time for an investment firm or a bank are not able to beat the market in the long run. Beating the market requires you to be super smart and also to invest a ton of time in studying your investment choices. As for most of the investors, at least one of the before mentioned is not true or possible. It is best for the overwhelming part of investors to just rebuild the market portfolio, for example by using ETFs, and doing better than 90% of all investors. A handful of investors like, for example, Warren Buffett are constantly beating the market. This most likely is a rare case of a guy having the skills mentioned before. But for most guys doing so, I would assume it's just pure luck. As due to variance and the big number of people being active on the stocks market, someone has to be more lucky than others. It could even be the case that Warren Buffett is just insane lucky and therefore having the great results. I mean, there are also people who win several times in the lottery. The same could also happen on the stock exchange. I hope you liked the video. If that's the case, please subscribe and or give me a like or comment below. Thanks for watching. Bye.